Good morning. Welcome to Trading Hour. I am Reema Tendulkar. With me are Pavitra Parekh and Sumaira Abdi, and markets are in a fine fettle. We had a gap up opening. We built on it. There's been a spring in the step in the last 30 minutes. There you can see we're at that 17,523 mark. We've crossed the 17,500 mark quite comfortably right now. And if you look at last Friday's close, before the big slam dunk which took place on Monday post the Jackson Hole meeting, the Friday's close was 17,558, which means we're just about 30 points in recovering all of yesterday's losses. And that just is a pretty good trend for our own market. So quite upbeat, and considering the Brent crude prices too have inched up to levels of $104 per barrel. Asian markets are mixed. Nikkei and Korean markets are upbeat. They've got a gain of close to about 1%, but Hang Seng and Chinese markets are struggling a tad bit. Talking about Asia this morning, Korean markets, there's been an important update from there. South Korea has cut the government budget for the first time since 2010. This is a move to reduce the pandemic-era spending as well as curb inflation. So the 2023 annual budget for South Korea will be lower by 6%. So inflation is hitting every part of the world. And South Korea, the central bank in South Korea, Bank of Korea, has already raised interest rates by 200 basis points since August last year. And this is another measure that they're taking to bring down inflation. So next year's annual budget for South Korea has been lowered by 6% compared to this year, marking the first budget cut in more than a decade. So it's hurting everywhere.
Oh, absolutely. But, you know, right now, considering the kind of global handover that we got, of course, today is looking like a really good looking screen for our own markets. And even since the start, it has only moved higher, right? So right now we're at the day's high. The stocks and sectors which are doing well, auto, like we've been pointing out to you for the past many weeks, is sort of in a bull market of its own. Even today, it's up 2.3%. The real estate index is actually the top sectoral gainer right now. So that one will also be up for you. Just some of the larger names which are doing well will be up on your screen. So something like a Maruti, you have Bajaj, all of these faring quite well in trade. And the real estate stocks also will, of course, come up. So something like a DLF is up over 3%. A lot of the smaller auto names, I've got to point that out earlier, but something like an Igarashi Motors, that one will come up. Atul Auto, look at the kind of moves that you're seeing on these. So across the board, looking good for that sector. On the downside, of course, you have Reliance, which is a little bit, muted right now. You have Bharti Airtel also, which is a little bit muted. And a lot of the pharma stocks are kind of trading lower today. So that's what's happening as far as the market goes. But Sumaira, this looks like a good looking screen. And considering the fact that the global markets, are sort of did not give us that kind of handover at all.
Yeah, it's like one up day and one down day. I think we've just gotten used to good days and bad. So here's what we have for you today. Indices edge higher despite a weak handover from Wall Street. Nifty crosses the 17,500 mark. Autos, realty and metals charge ahead. Defensives lag behind. We'll talk about the market fundamentals with Shyam Sundar Bhatt, CIO at Exide Life Insurance.
Ashok Leyland adds 2 models to its Bara Dost range of LCVs, unveils the Bara Dost I1 and Bara Dost I2, excerpts from our conversation with Rajat Gupta, head of the light commercial vehicles business at Ashok Leyland, coming up in just a bit.
Bharti Airtel is the top Nifty loser today as rival Jio's capital commitment to 5G announced at Reliance's AGM yesterday is nearly double of Bharti Airtel's. More details coming up later on the show.
And Reliance also made a slew of other major announcements at its 45th AGM yesterday. Jal Irani of Edelweiss Financial Services, as well as Shirish Pardesi of FMCG and the FMCG analyst at Centrum will both join us to discuss the key takeaways.
And later on the show, we'll also get you excerpts from an interesting chat with Nadir Godrej, chairman of Godrej Industries, in which he talks about demand trends, inflationary impact, and the outlook ahead. All of this and much more lined up for you over the next 60 minutes.
Shyam Sundar Bhatt, the CIO of Exide Life Insurance, is now here with us to talk about this big recovery that we're seeing in the markets right now and what the setup is. Mr. Bhatt, morning, and thanks so much for joining in. This is Reema here. That's the first question, right? It's so hard to gauge the market. Suddenly, yesterday, we had this big drop-off, and even in the U.S. markets, now the recovery. How would you assess the market right now at this juncture and the probability of the direction in which we are likely to head?
Yeah, thanks. So good morning to everyone. So as you said, intraday moves clearly are being extremely difficult to gauge and predict. But if we see the broader outlook clearly from the longer term perspective, the relative positioning of India has been getting stronger in the last few months, particularly from the perspective of the relative growth that we are likely to see versus other countries, as well as the relatively lower gap between inflation and interest rates that India now has as a country. Uh, but in terms of the near-term outlook, we remain cautious. Clearly, the strength in the market is a bit surprising. The up move or the bounce back in the last 2 months was not as surprising because there were quite a few pockets of the market which were undervalued at that time. But at the present juncture, there are very few pockets left in the market where the valuation upside for the next year or so has not already got captured. So from that point of view, the safety or the cushion of safety from for the overall market, we believe at this juncture is quite low at the current levels.
All right. Good morning, Mr. Bhatt. Thanks a lot for joining us. This is Pavitra. So you said that you are cautious on the market right now. And, at a time like this, when we do have such heightened volatility, perhaps the focus shifts more on just protecting your portfolio. So what would you think are good pockets to hide in and good pockets to have your money parked?
Yes, I think two factors which will help in understanding the way we are thinking about the sectors or the pockets. One is clearly that while the inflation risks are now appearing lower than what they were 1 or 2 months ago, clearly we are not out of the woods yet. Inflation is still clearly going to be a concern, maybe lesser in India, but definitely a global concern. And the global growth clearly is concerning, particularly given what is happening in the European Union and the US, and also the China growth not possibly living up to what was expected. Therefore, the sectors which are clearly dependent on a larger global growth, or the sectors which are going to be impacted by higher inflation, are the ones to be underweight on. So from that point of view, clearly oil and gas and metals, two sectors, and consumer stocks also from the India's perspective, which are impacted by higher inflation, are sectors which we are underweight on. Financials, clearly we are overweight, but we've seen the financial sector already have a good run in the last couple of months. So we do remain positive on sectors where like chemicals and agri, and some of the domestic focused names where India would be rather either insulated or will actually gain by what is happening globally in terms of partial shutdowns due to the high power costs.
Okay, hi Mr. Bhatt, morning. I can imagine that you're choosing to go underweight few sectors, but are there candidates who are where you want to take money off the table entirely? I mean, are there sectors which are no longer places where you want to remain invested?
Not really. So there are a couple of sectors where we do not really, have investments presently, or we have very negligible investments. So real estate, for one, is a sector where we currently do not have an exposure. Power utilities also, we do have an exposure, but a very small exposure. So these two sectors are very negligible as far as our portfolio is concerned. But from the other sectors perspective, whatever I mentioned was from the near-term outlook. Our outlook clearly is at least 2 years plus, because that is the earnings forecast that we generally build in when we look at investments. And from that perspective, there are definitely pockets in most of these sectors also where the sectors where we are underweighted, where there is still some value. But since the market overall, seems to have well captured the 2-year earnings growth of about 12 to 13% CAGR, which we are expecting between FY22 and FY24, at close to 18 times today for a 2-year forward earnings, we believe that the safety level for the overall index per se is quite low in the near term.
Mr. Bhatt, the big talking point has been the sharp rise in gas prices and the energy crisis which is brewing in Europe, and what winter is going to look like for the European region. Is there any way to play that theme in India? Is there going to be any direct, indirect impact on stocks, sectors, any theme, any correlation that you can draw to, understand from a market point of view in India how we could play or we get impacted?
Yes, so partially, so the direct impact clearly is on the gas consumers in India and the city gas companies, which clearly will be under pressure in terms of either having to pass on the full burden and therefore seeing a possible fall in demand or a shift to other fuels from some of the customer segments. The indirect benefit, yes, as I said, if there are shutdowns, particularly in the European Union of sectors which are dependent on the high energy on high energy utilization, we could see some sectors, so some pockets of metals, for example, some like aluminum, and some we may even see a scenario happening in chemicals as well. So we've been seeing news of late of what is happening in paper, for example. So these are some of the smaller sectors, but we could, if this continues into the winter in EU, we could find more of the sectors opening up for where India can possibly gain a tactical advantage in the next few quarters.
So negative on CGD companies because they may not be able to pass on the entire burden, and there is an opportunity for specialty chemicals or chemical companies and paper companies in India, right?
That's true.
Okay.
And aluminium, as I mentioned, so because we have aluminum smelters also, facing the brunt. Plus, as I said, we may find more sectors opening up in the next few months if the gas prices continue to remain high or go higher. If the crisis continues into the winter in Europe.
What about auto companies? Many of them have operations, manufacturing plants in Europe. Is there a risk of factory shutdowns? And is that something that the street is worried about or pricing in?
Frankly, I think the shutdowns are a news which we have just started seeing in the last few days and possibly not yet factored in by the markets.
So do you think this would be a good place to, any sort of approach to the auto stocks? Would you sort of recommend that? I mean, we have been talking about the kind of run-up that we've seen in auto names and auto ancillary companies as well.
So on auto in particular, of course, in the last few months, we've seen a substantial re-rating and most of the positives for the auto stocks seem to have got factored in. I know we are seeing a continuation of that rally today. But we would be neutral to slightly underweight on the auto sector. And from the perspective of short-term outages, it's difficult to take longer-term calls on this because unless some companies have got excess capacity now which can supply and meet the demand, unless there is a long-term disruption in the capacities in a particular geography or a sector, one may not see a long-term advantage for any of the companies in India. So this is at best a tactical kind of a short-term play for investors who may want to look at.
Hey guys, welcome back. You're still watching Trading Hour, and let's now focus on the auto sector. Sector heavyweight Ashok Leyland launches 2 new variants of its popular LCV range Bada Dost as it looks to expand the LCV portfolio and gain market share. So the Bada Dost I1 is priced at 7.9 lakh rupees, while Leyland is offering the I2 variant at 8.63 lakh rupees. Both models boast of a wide deck and other high-end specifications as well. Note that the company has sold over 35,000 units under the Bada Dost range since its launch 2 years ago. So on these new variants, Sonia caught up with Rajat Gupta, who is head of LCV business at Ashok Leyland, and began by asking him which sub-segment within the light commercial vehicles the company would target with this launch, and also whether this would be offered with both fuel options, diesel as well as CNG. So listen in.
We are launching Bada Dost I1 and I2, which is in 2.5 ton and 2.8 ton segment. And just to talk about Bada Dost is a platform which we launched 2 years back, and that time we unveiled 2 products, which is I3 and I4. Actually, it was 3 ton and 3.5 ton segment, and it became instant success among the customer because it is designed keeping customer experience and customer comfort in mind. Now, to answer your second question, as of now, it is in diesel version, and towards the last quarter, you will see CNG version of Bada Dost as well.
Okay, so post this launch and including the previous launch of Bada Dost, can you help us with what the addressable market is in the LCV space and what kind of growth are you looking at Ashok Leyland?
Yeah, so these products will be placed in sub-segment of 2 to 3.5 ton in the LCV space. And TIV growth is beyond our expectation. We expected TIV to grow at about 10 to 12%, but actually post-COVID, I am seeing a huge growth, which is growing at about 16 to 18%. So I am expecting that the year end would be around 16% growth in TIV segment, which is much better than pre-COVID levels.
Okay, so 16% growth in the TIV segment and demand is very strong. How many more light commercial vehicle products can we expect from Ashok Leyland stable this year?
See, we have filled up the entire segment 2 to 3.5 with all the diesel versions. Now, in CNG, we have only those one model. Now, we will be launching 2 more products on CNG, those plus CNG as well as Bada Dos CNG, which will offer higher power in CNG segment.
Okay, so can you just help us with what is the market share currently in the LCV segment that you enjoy? And with these new launches, what are you targeting in terms of market share by the end of the year?
It's anybody's prediction, but as of now, market share is about 20.3% in LCV 2 to 3.5 ton segment. And of course, the launches will add to it.
Okay, so for the LCV business, what kind of demand trends are you looking at? Overall, I'm trying to understand, is it largely for infrastructure activities? It is commercial purposes? Is it more for e-commerce, logistics? Because, that has been a big growth driver in the recent past as well.
So the drivers for LCV business is e-commerce, retail business, hub and spoke transportation, logistic business, and market load operator. If the demand among consumer increases, then overall demand LCV increases. And in rural segment, because of good monsoon, if crops is good, then demand will increase. These are the growth driver for LCV, and touchwood this year has been phenomenal so far.
Okay, this year has been phenomenal. What about e-commerce and logistics? I'm just trying to understand, compared to last year, has that gone up in a big way?
Yes, a lot of new players have come in and they have increased their business. So, of course, there is a demand coming up.
Okay. How are the discounts in the industry now relative to what we saw a couple of quarters ago?
You have asked very relevant question. This industry is driven by heavy discounts. However, we work on value proposition and we offer value for our customer. As I said, there are a lot of industry first feature which is good for customer convenience and overall saving. And overall, because of these, customer gets benefited, and total cost of operation for customer is low, hence making more profits.
Okay. So overall, sir, just to wind up, since you have announced these new launches and you are looking at big growth from the LCV space, how much do you think the industry can grow, the LCV industry, over the next couple of years? And what would Ashok Leyland's share be in that?
For LCV, we are targeting about 24 to 25% share, and industry would go at around 16% this year. And CAGR of next 3 to 5 years would be around 10 to 12%.
Hi, welcome back. You're watching Trading Hour. Let's focus on what's happening in the auto and related spaces. A JP Morgan report says that disbursement in auto financiers have now picked up pace. Abhishek has all those details. Abhishek.
Well, Sumera, as you mentioned, JP Morgan has written on auto finances, wherein they say that, disbursements are picking up after 4 years. So they also say that, higher industrial activity, rural recovery, as well as positive property cycle should drive the growth of disbursements going ahead. So major auto financiers have seen a loan growth of 7% per annum between or over the last 3 years when compared to a CAGR of 17% between FY11 to FY19. They also say that, hard crude price could impact the operators' profitability. However, they say that, banks appear to be better in terms of gaining the market share away from the NBFCs. So they say that, they expect a rotation in stock performance that has been seen YTD, and they have underweight on Chola as well as MMF Financial, while they remain neutral on Shriram Transport, and they have an overweight rating on IndusInd Bank. So they expect growth and ROE differential to narrow in spaces where, we should also see a narrowing of valuation differential that, NBFCs enjoy and the banks enjoy. Back to you.
Thank you very much for that. Let's invite Mitesh Thakkar of earningswave.com to take stock of the market technicals. Mitesh, morning. We've pretty much erased all of yesterday's losses now. We are back to last week's Friday's closing levels. Where do we head from here? Do you think the markets perhaps have made a bottom at that 15,166 mark, the low that we hit yesterday? Or do you think this recovery should be sold into?
So I think, we've been calling for some consolidation and contraction, and the lower end of the range was closer to about 17,000 odd areas, which is where the 200-day average is placed, actually 16,973. Having said that, I think, broadly, I think this market should not be sold into, because we are still thinking that, this eventually is a medium-term uptrend, which will, after this contraction consolidation plays out, will break on the upside. But to accumulate more at lower levels, or look at stocks which are giving breakouts, and I think those kind of stocks can be possibly looked to add into the portfolio. So trade with long bias, clearly I think there's nothing much to worry about. But on the index, I think you might want to strategically time the entry, because as the index consolidates, a lot of stocks will keep on making new highs or give reversals from lower levels, and they could be bought into for the time.
Welcome back. You're still tuned into Trading Hour on CNBC-TV18. It is 1.3% higher on the index right now. The mid-cap index pretty much completely in line, 1.4% higher there, and all of the Nifty stocks are in the green as we speak. Even Bharti Airtel, which was seeing a little bit of red, has now moved into the green. But with that, let's bring you an interesting conversation now. Shilpa Ranipeta spoke to Nadir Godrej, chairman of Godrej Industries, and started by asking about how he sees rural demand panning out in the country now. So hear him out.
There's been a little bit of deficiency in the monsoon, but overall it's not all that bad. And we also expect very good rabi crops, because in the last few years, the monsoon has extended quite late, and that's very good for the rabi crops, but it's very variable. So the kharif crops have been, for the last 2 or 3 years, some degree of damage. But I don't think rural demand is all that bad.
Okay. What about the impact of inflation, though? Because not just your consumer business, it's also had an impact on your agri-business as well, with livestock, the cost there also going up. So are you seeing any signs of easing on that front?
Yes, we saw that the July inflation was lower than the June inflation. And commodity prices, which shot up after the beginning of the Russian invasion of Ukraine, have come down considerably.
Right.
And Indian inflation is largely influenced by commodity prices.
Right.
So by March, April, everyone is expecting inflation numbers in India to be quite reasonable. And so we don't have to worry much on that front. In Godrej Consumer Products, there was a little bit of an effect, but things are picking up now, even for that business. Godrej Properties, things are picking up.
Right. So I want to understand about Godrej Capital also, your newest business. You've also, Godrej Industries has also upped its stake. So far, what's the progress been? What areas are going to be your immediate focus?
In the beginning, it's mostly housing finance, but later on there may be other things. It's growing quite rapidly. And we will continue to invest in it for a little while. And ultimately, maybe in 2 or 3 years, we may consider an IPO.
Right, wonderful. So for Godrej Capital, you're saying in 2 to 3 years you will consider an IPO?
We'll consider. Yeah, it depends on how it progresses.
Right. Yeah. And going to, one last business, which is also properties, I wanted to understand, how's the revival there been? Also, the consumer sentiment that is improving. Are you seeing that also coming into the properties? Are people buying more homes? How's the business going?
The property business is doing very well.
Right.
Yeah.
So finally,
demand is good.
So finally, wanted to understand about a lot of speculation talk has been going on about the split in the Godrej business. Any update that you could give us on that front?
There is no further developments, no comment.
So any timeline or when we can expect something?
We don't know.
All right, so that is an interesting chat there with Godrej. Take a look at some of these real estate stocks which are doing very well today. So something like a DLF, that one is seeing good gains come through. It's over 3% higher. The real estate index in itself is seeing a move of over 2.4%. So some strong gains coming through there. DLF is up on your screen around 3.8% higher. There are a lot of the smaller names as well, whether it's a Brigade, Prestige, all of these seeing good gains. If you take a look at the larger cap stocks, it is autos which are really sort of ruling this session right now. So you have Maruti, which has moved even higher, Tata Motors, Bajaj, M&M. Remember, we do have the auto sales which will start trickling in on Thursday, because tomorrow is a market holiday, and on the 1st of the month is when we're going to start getting all of the sales figures. And ahead of that, all of these stocks looking quite good right now. Some of the banking and financial names also, so whether it's an IndusInd Bank, the Bajaj twins, all holding up quite well. But with that, let's move on and get you another story. In a first, the chairman of the Central Board of Direct Taxes, Nitin Gupta, has spoken to CNBC-TV18's Tim C, and he shared the future plans of taxation policy, whether taxpayers' burdens can be reduced or not. So listen in to what he said on that front.
Right now, against the budget target of 14.20 lakh crore, we have achieved collection of more than 4,75,000 crore, which is at the growth of around 33%. The gross collections are still better, with a growth of around 38 to 39%. In spite of more refund outgo, which we want that should be enhanced, the collections are very robust at the and going at the rate of around 33%. Corporate tax as well as personal income tax, on both the side, the collections are robust, and I think the actual picture would emerge once we get the second installment of advance tax in the month of September. So a better analysis can be made around 20th of September once we get the figures for the second installment.
Hi, welcome back. You're watching Trading Hour. Let's get into market opinion. Earlier, we spoke with Rana Gupta, who's a senior portfolio manager at India Equity Specialist at Manulife Investment Management. So let's hear out where he thinks the markets look to be headed.
In this globalized world, we cannot ignore the US interest rates. This kind of outlook where the rates are getting higher, not just US Fed, but other central bankers becoming more hawkish, geopolitical scenario uncertain, and also there is this increasing risk of inflation and all of it. Around this time, to get into the stock market, you need supportive valuation. So coming to India, the top line growth will be good. So even with margins lower than expected, the absolute profit delivered is still good. So earning cuts will be lower. I think the longer term India argument, positive argument that we have been talking about for a long time now, led by digital economy, manufacturing, and now increasingly we are seeing pace of infrastructure improvement and all of it, that stays. The domestic looking, or the inward looking indexes like auto, FMCG, they have done much better than IT and pharma. Banking, YTD, I'm talking about YTD performance. Banking has not done as well, but we expect that to change.
All right, that is the word coming in from Rana Gupta. But let's also bring you some expert opinion. This comes in from Mohammad El Arian. This is on the Fed's aggressive policy stance, as well as what Fed Chairman Jerome Powell's hawkish signals at the Jackson Hole can mean for the markets going forward. So listen in.
So he finally sent the correct message. He should have done that months ago. He was unambiguous, he was clear, he stuck to his script, and he did it in 8 minutes. And the market is starting to realize that when your Fed chair mentioned inflation 45 times in 8 minutes, something is changing. That's the good news. The less good news is he didn't deal with the policy errors of the last 18 months. He should do that at some point. And he hasn't dealt with the fact that they have a monetary framework that's not fit for purpose. So if he sticks to his script, we should expect more hawkish talk as we go forward. I think what the market hasn't quite grasped are three things. One is the global economy is slowing at a much faster rate. And if you go beyond the US, it looks terrible. Mm-hmm. The US is the best among all the other major economies. So the first thing is to what extent the market has understood the slowing of the global economy. The second issue that I don't think the market has fully internalized is other central banks are going to become a lot more hawkish. Mm. The ECB narrative this weekend was notably hawkish. And the third thing the market has got to recognize is how do you deal in a world of dispersion? We're coming from a world in which everybody was subject to the same common shock. Now we're seeing differences. And you have to navigate there. So I think there's more volatility ahead.
All right, let's focus on the healthcare and pharma space. Ekta is standing by with the report card for Q1. Ekta, over to you.
Well, yes, Q1 FY23 threw up some interesting trends in the pharma and the healthcare space. While healthcare companies such as hospitals did meet expectations, the India generic companies' performance was weak. In fact, Jefferies in their note points out that the largest miss in Q1 FY23 was from pharma companies, primarily on account of US price erosion. The US pressure in the markets combined with factors such as higher raw material costs resulted in margins being weighed down in Q1. Companies such as Lupin, Alembic and Alchem reported some of the lowest margins ever in the quarter gone by. On the other hand, hospitals within the healthcare segment met analyst expectations. Factors such as occupancies normalizing, price hikes, higher surgical and payer mix, international flights resuming resulted in parameters such as the average revenue per occupied bed, hence margins improving. In fact, hospitals on an average saw high single to double digit sales growth and 200 to 350 basis points margin improvement sequentially. So is this dichotomy in the performance expected to continue? For hospitals, analysts point out the outlook is likely to remain healthy due to factors such as occupancies looking to rise going forward, also along with the case mix and the payer profiles improving further. While for generic pharma companies, recovery is possible only in the next 1 to 2 quarters or 1 to 2 quarters away. So is the preference shifting? For some, yes. Jefferies' pecking order now is hospitals, followed by contract drug manufacturing companies, and finally, generic companies. Similarly, a healthcare fund manager says their preference is in all domestic focused stories, from hospitals and diagnostics to API companies, which could benefit from the China +1 factor. And yes, while US generic companies are likely to continue facing headwinds such as price pressure, input cost inflation to risks from the US FDA's inspections or litigations, the advice from some is not to entirely avoid the play, but to be selective. HSBC, for example, likes pharma companies that, according to them, are moving up the value chain and have near to medium-term drivers. They like stocks such as Cipla due to their pipeline of US launches, and Sun Pharma, which is on improving profitability in their specialty product sales. Lastly, while healthcare companies might be emerging as a preference, it is important to highlight the risks. Diagnostic companies, which are a healthcare play, are seeing stiff competition, which is pulling down margins. An example was Fortis's margins being pulled lower due to their pathology arm in Q1. Similarly, investments in new verticals, for example, Apollo Hospitals, increased their 24/7 investments, leading to EBITDA loss in the division. A strategic investor, a scale-up of the arm will be a key factor to watch going forward.
All right, Ekta, thanks a lot for getting us that complete report card on how pharma and the healthcare space has fared in Q1. With that, we're going to slip into a short break. But as we do that, here's a quick reminder for our viewers. It is that time of the year again, and Money Control's Pro Financial Freedom offer is back with added benefits. So you can get a Money Control Pro subscription at net zero cost by claiming exciting offers worth 1,500 rupees from our partner brands. Grab the benefits now only on the Money Control app or website.
Welcome back. The market is going strong. We're up 230 points in the Nifty, again of 1.3%. But one stock which is underperforming today relatively is Bharti Airtel. So that's up just about 0.4%. In fact, the early rate, the first rate on Bharti Airtel was actually in the red. Now, we're just taking forward what Jio announced yesterday at the AGM. Well, the one thing that stands out is the capital commitment of Reliance Jio. Now, yesterday, Mukesh Ambani threw a big number. They said, we will be investing 2 lakh crore in the 5G business for rollout. This probably includes the 88,000 crore that they've already spent on the spectrum auctions, which means you're left with a balance of 1.1 lakh crore for a pan-India rollout, as well as all the overhaul that you need on the infrastructure front. So remember this figure of 2 lakh crore that Reliance Jio will be investing. Now juxtapose that with what Bharti Airtel's implied capital commitment would be. Now Bharti Airtel spent about 44,000 crore in the auctions. And in the Q1 conference call, they said that the 5G related capex will be similar in the next 3 years to what we have done so far. that would give us a figure of about 60,000 crore. So you add up the 44,000 crore that Bharti has spent on the auctions plus the 60,000 crore that the company believes will be their capex going ahead for the next 3 years, we arrive at a figure of about 1.05 lakh crore, which is nearly half of that of Reliance Jio. So the understanding right now in the market is that there cannot be such a big gap between Reliance Jio's capital commitment and what Bharti's capital commitment is implied, going by what the management had to say. So there is a possibility that Bharti's capex will need to be upped going forward, and especially if they do invest in that expensive 700 megahertz, then of course their overall capital outlay is going to be a lot higher. So that's the point number one, that as of now, Reliance Jio's 5G capital commitment is more than that of Bharti Airtel, and significantly. Secondly, Reliance Jio's rollout timelines are more aggressive. Now, Mukesh Ambani yesterday said that they will achieve a pan-India 5G coverage by December of 2023. Bharti Airtel in the Q1 conference call said that they hope to cover every town, every key rural area, achieve a pan-India coverage by March of 2024. So Reliance Jio's pan-India coverage push is going to be about 3 months faster than that of Bharti Airtel. So that's another point of view. And finally, I think the big worry surrounding telecom is that will the operators be able to make money off 5G? They're spending a lot of money, but globally, the precedent is that operators have not been able to get incremental ARPUs from 5G, and India historically has been a low ARPU market. People have gotten used to very low tariffs, and even whenever you see the telecom operators hike the tariffs, like we had in December, you've seen many consumers downtrade. They move to a lower pack in order to save that extra money. So India historically has just gotten used to to low tariffs. So will operators be able to hike tariffs on 5G commensurate with the kind of investment that they're making? That remains to be seen. And that, of course, is an overarching worry for the telecom operators from a market point of view. But let's take this discussion forward from the Reliance AGM and find out the implications for the oil to chemical as well as the new energy business. Jal Irani of Edelweiss Financial Services is with us. And to talk about Reliance's FMCG foray, we're joined by Shirish Pardeshi, the FMCG analyst at Centrum. Gentlemen, thank you very much for joining in. Jal, my first question to you is, Reliance has announced some big capex plans, right? 2 lakh crore or incremental 1.1 lakh crore for the 5G business. On the oil to chemical business, they've announced 75,000 crore of capex. What does all of that mean from a returns point of view, from stock in terms of their balance sheet, etc.? And when you spoke to your clients post the Reliance AGM, what is it that excited them? What were the hits and misses according to you in terms of feedback?
Okay, so on the first part, I think the capex is only going up. Clearly, there's a formal announcement of about 3.5 lakh crores, 2 lakhs in the digital business, 75,000 in new energy, and 75,000 in O2C. And especially in the new energy business, I don't think, given the size of the opportunity and given the pace at which Reliance is scaling up, and rightfully so, that actually about $10 billion is going to cut it. So in my opinion, actually the capex is going to be, in fact, even larger. However, the way we look at this capex is that Reliance is generating about a little more than 1 lakh crore of operating cash flows every year. And therefore, this is fairly manageable. Of course, at the moment, they're largely net debt neutral. And in fact, one of our pain points about a year back is that a company needs to have a little amount of debt. And being net cash positive is actually not a good thing, especially as some amount of debt actually reduces your weighted average cost of capital, and in fact enhances ROE. So actually the larger capex, at least for the moment, is welcome, and perhaps their balance sheet could take more of that. Sorry, your second question is, what are the hits and misses?
The feedback that you got
correct?
from your clients, the feedback that you got from your clients post the Reliance AGM when you went with them with the takeaways. What is it that they like? What is it that they were disappointed or made them cautious?
Sure. So I think clearly clearly the most significant opportunity where we truly believe that globally is the sunrise industry is new energy, and India especially, in my opinion, is potentially going to be the Middle East of the world in this space. So this is an area in which we were looking towards more granularity. And I think to a fair degree, we have received at least, we've received at least some degree of granularity. For example, Reliance has stated that there'd be 20 gigawatts in this space. Notably, the largest in the world, Longi of China, is 60 gigawatts, which is completely off the graph. And 20 gigawatts would, in our opinion, put Reliance in sort of the top 5 to 10 in the world fairly quickly in this space. Also, it is the technologies which Reliance is adopting, which, I mean, the way we look at it is, this is the Tesla moment for whoever can do this right. And the acquisitions which Reliance has made, and on the back of that, the technologies they're going to adopt is going to put them right up there. So for one, while Longi may be the largest in the world, Reliance is potentially going to be more integrated than even a Longi, and perhaps one of the most integrated in this spectrum. And in fact, the efficiency of the solar modules, the solar cells that they're going to have is going to be top-notch comparable to a Longi. So this sort of details and some degree of granularity gives us and timeframes that they've laid down in what I view as their most promising business is indeed actually very heartening. One sort of the other thing was a significant confirmation on their gas business, where the chairman stated, if I'm not mistaken from memory, they're on schedule to ramp up from becoming 20% of India's gas supply to 30%, which is actually very important because we believe that the gas business within a short period its EBITDA is going to be nearly as large as the entire retail business, which is now more than a dozen-year-old business, right? So that's something that the market, I think, does not appreciate or understand. What were the misses? Well, perhaps there was a lot of talk about, I wouldn't say it's really a miss, but, I think the emphasis seemed to be more on the digital business and the retail business, while actually some of the other interests, like new energy seemed to be more which is, while there wasn't too much more incremental excitement to be announced or found on those businesses versus actually something like a new energy. So I wouldn't say it's really a miss, but perhaps, given this sequencing of things, one was looking for more exciting things on, the digital and retail business, perhaps is the way I'd look at it.
All right, gentlemen, good morning and thanks for joining us. This is Pavitra, and let me also bring Shirish into this conversation. Shirish, speaking of exciting announcements, they have said that they want to get into the FMCG space this year itself. They're looking at, daily products, high quality daily products, and they're also saying that the pricing will be quite affordable. How do you read this announcement? And, in the near to medium term, how do you look at this within the larger FMCG landscape as well?
Thank you, Pavitra, having me on the show. As you said that the intentions are very clear, and it's not that they have not tried. In fact, they have the benefit that already there are about 15,000 odd retail touch points, the Reliance Fresh and various formats which are available. On top of it, the digital is also going to be very strong. Having seen the FMCG companies, I think which comes to my mind is two things. First thing is that how the quality will be maintained, because when you are managing with a lot of suppliers, managing the quality is going to be a big challenge. And unless until you deliver the consistent quality, I think how your brand will get scaled up. FMCG is all about creating brands and supporting those brands with the advertising. While you might say that India has about 11.5 million retail touch point, and you might get maybe about 2.5 million touch point very quickly through the geo and the interface through the digital. But I think what I'm seeing that managing with the large suppliers and maintaining the quality is going to be a big challenge. On the answering second question, I think it's a good example because there is no success model which we have seen, which is a national player in terms of private label. I think Reliance has already spelled out they want to achieve. So that's what I'm saying. The intentions are very good, but to execute that will take a little time. In the short run, when we look at the full-grown FMCG companies, I think these all companies has created brand over 35, 40 years, and consumers are used to getting those brands. The only differentiation which Reliance is talking about, affordable price. And I think in general terms, affordable is the large context. Every consumer has got its pricing in their mind. And if the consumer hits those price, and if it gets at the right price, I think there will be a fall and there will be a fanfare for the products which is in the private label. The last point which I would try to summarize, and again I'm repeating, that there is no success model which we have seen in India. But on a flip side, when we see that there are a lot of regional and D2C brands which are penetrating and mushrooming, I think there will be some check on those brands, because if there is a scale which Reliance is talking about, definitely through their own efforts, they will be able to achieve that.
Mr. Pardeshi, Jal, we would have loved to continue this conversation a little further, got more questions, but we are completely out of time on this show. Thank you very much for joining in and sharing your insights. Stay tuned with us, folks. Halftime Report is up next.